Welcome to the Boiler Room Trading Podcast. If you'd like to be our next guest, follow the first link in the description of this video and add yourself to our podcast guest list. What's going on, traders? Today, we're talking about the number one rule a trader must follow when he or she is under the pattern day trading rule. Yes, the evil pattern day trading rule that exists for most people with an account under $25,000. That is what we are going to be talking about today. So a little background on the pattern day trading rule to put it in simple terms. If you don't have $25,000 in your account, you are most likely going to be one of these people we are discussing. You are under the pattern day trading rule. That rule means you are only able to take 3 round trip trades per week. Thus, if I buy stock ABC today and then sell it an hour from now, that counts as a day trade. You're able to make 3 of those in a 5-day trading period. 5 days would be Monday, Tuesday, Wednesday, Thursday, Friday. You have a full week of trading to take 3 round trip trades. There always seems to be some confusion on that, but it's pretty straightforward. So now that we've cleared that up, what's the number one rule that you have to follow? Well, what happens if you've already used 2 of your trades or maybe 3 of your day trades? And if you were to make another trade, you would break the pattern day trading rule. So if you're not familiar, if you trade too much, do too many day trades under that PDT rule, then your account will get locked for like 90 days. Sometimes it might be quicker, but usually it's 90 days. Sometimes you can finagle your way into getting out of it, but again, most likely 90 days. You are going to restrict and lock your account for 90 days. So this is the most common problem we see traders make. They first start trading, they've run out of day trades, and they enter a position because they think a stock is going to go up. Or they have discipline problems where they're not able to resist trading, even though they shouldn't take another day trade or should not enter a position because they cannot sell it because they're under the pattern day trading rule and they still take a position. This is really bad because you are pretty much eliminating any sort of risk management at this point. So if you're somebody under the pattern day trading rule and you have no more day trades left this week or next week or any week to come, you never enter into a position. You never take a new position. Because what if something dramatic happens that day and the stock, for whatever reason, was going to go bankrupt, or Tesla's new car just killed someone, or the Clorox bleach wipes or whatever on your skin cause like acidic burning? Whatever the case may be, whatever stock you're trading, if you enter that stock, take a new position, and you're under the pattern day trading rule and you cannot sell, you're screwed. You basically just take away the most important part of trading, which is managing risk. If the most important thing is managing risk when trading, and you throw that right out the door, you're pretty much guaranteeing yourself a straight shot to a loss. So the number one rule you follow is never take a position that you cannot close out immediately, worst case scenario. Because what if you thought something was going to go up and then you take a new position and then it starts to crash because whatever, and then you can't sell? You've thrown out risk management straight out the window. That's what you don't do. So the scenarios we usually see this happen are when a trader has run out of day trades and they know that, and so they take a position knowing they can't close it the same day if something goes wrong, but they're going to hold it overnight because if they buy it today, they're out of day trades, but they still buy something today, hold it overnight till the next trading day, then it's not considered a day trade and it's more of an overnight swing trade. So it's happened over the course of a 2-day time period, not the same day. They get in this position, hold it overnight, and then it doesn't count as a day trade. And the reason they do this is because either they think something's going to go up or maybe go down, and they're out of day trades. So they're playing and hoping for an overnight gap or an overnight move in their favor, which is also pretty unlikely to happen most case scenario. Most of the time, the stock will jump a little bit overnight, but by the time it opens and you have that morning swing, it's usually going to be at your buy price anyways, or you're at a loss or you're at a small win. You usually don't get that much of a significant move on your stock overnight to really make a great trade most of the time. And chances are you're just not going to catch it in the first place, especially if you're a beginner. So you never do that. And the problem is when you do that and you take this overnight position, most of the time it's not going to gap in your favor. And then you just set yourself up for a loss. And then if you get into a position and things go wrong immediately and you want to close out your position, you can't do it until the next day, or else you're going to lock your account for 90 days. And this is throwing risk management completely out the window. And that's exactly what we see tons of new traders do. And it was always a number one rule of mine to teach is if you're under pattern day trading, you never take a position intraday or just at all unless you can 100% close it immediately right after you buy it, worst case scenario. And if you can't do that, you shouldn't be in the position and you should not be entering it. Now, if it was something that you were going to do long term, then sure. But why would you even be under the pattern day trading rule if you weren't trading? And that's another thing. You never day trade a stock. You never take a day trading entry and then try to turn that into a swing trade just because it's moving in your favor. I also see that a lot of times is a trader will get into a trade. Things are going really well. And rather than them sell and make profit or take it on a good move, they hold it because they don't want to waste a day trade. They want to keep their day trading power. And they don't want to waste one of those day trades. And so then they try to hold it and then they get all their gains wiped out. And then they either cut their loss, they use their day trade and they don't make any money, or it goes up and then they hold it, not trying to sell it and waste a day trade. And then next thing you know, it gaps down overnight and then they lose more money instead of making any money, but they didn't waste a day trade, but now you don't make any money. So that's part of the problem too, is that when you're day trading, you're not swing trading. Swing traders are looking at stuff a little bit differently than intraday traders. And their entries and their risks are going to be defined a specific way. And that is not going to be the same way that is defined for a day trader. So if you take an entry intraday for a day trading move and it starts to go in your favor and it's starting to do really well, that's great. But you also have to understand why you invested, not why you traded it. You traded it because you thought you were going to make money, but you invested in it because you've seen potential for it to make a move. Was that move a day trading move, or are you looking at the swing trading move? So if you enter with a day trading setup and mentality, then it should not flip to swing trading mentality when it starts going in your favor. That's when you're probably getting a taste of the euphoric high where you're winning and things feel good. So how could they go wrong? Sort of feeling, hashtag cough, cough, Tesla. But that's the case. If you get into a day trade, things are going really well, don't change your perspective and then try to make it a swing trade and hold it overnight to avoid pattern day trade or anything like that. You should never take a day trade and then make it a swing trade unless you can justify that your entry is good enough to remain in the game and hold it for a swing trade. And a lot of times, day traders, where they buy, don't always have the best entry for a long-term hold throughout the day and overnight many times. So I hope you guys learned something new from this podcast. I hope you guys like tuning in. As always, thumbs up on the video, share this wherever you may, and I hope to see you guys and hope you guys listen in on the next one. Everybody, take care.